Welcome to the B.F. Anderson Technical Report for June the 16th. The Great Depression, October 24th, 1929. Wall Street in panic as stocks crash. You know, the difference between a recession and a depression is that during the depression of the 20s and the 30s, we lost the banking system, and that was a major problem, and so I've gone back and I've studied the market during this period, and I found that there were certain people or certain analysts, certain advisors that were very successful in taking care of their clients and their portfolios during this period. And there were people like Jesse Livermore, Bernard Baruch, Gerald Loeb. They got through the Depression, and the reason they got through it was they were what we call trend followers. Now, we are trend followers. Now, trend following is nothing more than observing the trend, not predicting the trend, but just taking it a day at a time and observing the trend. So if you look here, here was the crash, the initial crash back in 29. So you would say, okay, well, we're broken trend here. Now you get a rally in here, what we call a dead cat bounce, and then the trend continues. So the most important thing to notice about the graph is that it is a very definite downtrend. So as we get into what's going on today, and I did want to mention this before I get into our current charts, this is an ETF that tracks Bitcoin, and look at that trend. I mean, just tanking. I get questions almost daily, especially young people that are very interested in what's going on with Bitcoin, which to me just doesn't make any sense. I don't understand why this seems to be where billions of dollars have been going to. And you kind of have to wonder somewhat if what's going on here with Bitcoin and the cryptocurrencies is not having some type of impact on the overall market. So as you can see here, the downtrend continues. Now, what's interesting about the NASDAQ here is we've had basically one leg down, a rally, a dead cat bounce, second leg down, a smaller rally, and now we're getting the third leg down. So hopefully we bottom as we go through the three legs down. Now, if you look at the graph on a monthly basis, you can see it continues to stay below the 10-month moving average and actually breaking to a fresh low. So the trend is down. NASDAQ on a weekly basis, same thing. We're below the 35-week moving average, continuing to make fresh lows. The market is not in a positive way at this time. Now here's the S&P. Again, leg down, dead cat bounce, leg down, bounce. Now we're in the third leg down. Where does this stop? We don't know, but we do know that the trend is down, and that's all we really pay attention to. Here's the S&P 500 on a monthly basis. Again, the 10-month moving average actually rolling over, making a fresh low. Here's the weekly, again, breaking below the 35-week, fresh low. So it's not good news. I'm sorry about that. But this is the aggression index, which is my favorite indicator. It really has been a very good way to keep track of things because basically I understand how to think like an institutional investor. And being that, I'm an individual investor, I can do whatever I want to do. I don't have to do anything. And that's basically what I've chosen at this point. I'm just sitting on my hands waiting for this trend, this downtrend, to base and get back into an uptrend. So you can see here with the aggression index, waterfall decline. We got a little bit of a rally in here, failed. Now we're getting another rally, somewhat failing, but we are making a higher low at this point. So what we really want to see again is we want to see a formation where we come down and we just quit dropping and we start at least moving sideways. That's what we're looking for. Now, on the three economic indicators, you can see here interest rates are really kind of getting up there, 3.5% on the 10-year. Price of oil looks like it's kind of trying to turn down a little bit here. The oil stocks we'll talk a little bit about, starting to see some real serious weakness there. Now, on the financial stocks, serious weakness on the financial stocks, meaning the banks, insurance companies. You would think with these higher interest rates that wouldn't be the case, but I think we're worried about recession, and that's what's what's causing these to have a tough time. Now, on the new lows, not looking good there either. You know, we started to really get under control here a little bit, under 40 a day, but barely, just for really about 4 days. Then on the last couple of days, we've seen numbers that are pretty darn high. Just the other day, we had 850 new lows on the New York Stock Exchange. On the sentiment readings, we continue to see a lot of fear. This number will get updated today. However, we continue to be in fear, which is somewhat of a buy signal. We're at a minus 25.9 as of last week. Now, on trend strength, back to zero, we did kind of get above that lower moving average, but then boom, came right back down again. The rally basically failed. Now, on the S&P, same thing. Trend strength's gone to zero. We rallied and failed. Here we have the Volatility Index, which I'm using, by the way. I'm using a 5-day moving average on this particular indicator. Back above around 30-ish. In a way, I hate to say this, but the way to wash this market out and finally get a bottom put in, we may have to see readings of over 40. That could be the case. Now, I did want to point out Treasury bonds. The 10-year Treasury bond continues in a downtrend. As interest rates move higher, these bonds will continue to depreciate in value. Inflation is not a good place to be with bonds. Now, on the percent of stocks above their 200-day moving average, now this is the NASDAQ, we've gotten down to readings of around 10, which means 90% of the stocks on the NASDAQ are below their 200-day moving average. Now, we also want to look at the S&P, the New York Stock Exchange, because this indicator is really pretty much designed to give you readings of, is the market oversold or is the market overbought? Well, once you get below 20, which means 80% of the stocks on the New York Stock Exchange are below their 200-day, you're starting to get into that oversold area. But you can stay oversold for quite a while, so it's not really an indication to do anything drastic. Now, on the top 10, I wanted to mention that it's mainly, again, energy stocks, oil, coal, that kind of thing. You can see here with Alpha Metallurgical, we pulled back, we broke below the 50-day moving average, starting to see some weakness even in these areas. You know, in a bear market, they come after everything. Now, here's Antero Resources, which is mainly a natural gas producer. Again, you see that break below that 10-day moving average. Then we get what we call a violation of the moving average, and then a breakdown below the 50-day moving average. A little bit of a bounce yesterday, but nothing to speak of. EQT, another natural gas producer, same picture. We broke down below that 10-day moving average. Now we're violating the 10-day moving average. Continues to look weak. This is Northern Oil and Gas, which is, again, another energy play. You can kind of see it's looking kind of toppy here. I would be cautious with this group. I think it's a crowded trade. Valero, big refiner, actually a very good company, but you can see how the volume's coming in on the sell side. These stocks are starting to look tired. I think they were a place for people to hide, but it's no longer working out. So if you have any questions, please give me a call. Thank you very much.